Hi, this is David with the Enzo Trading System, and today I would like to talk about manual trading versus algorithmic trading. It's a topic that I touched upon before, but I would like to spend a little bit more time on this, and I also need to specify that in many ways this is very much my personal opinion, and some opinions that to some degree I will change in the future, so take it for what it is at this point in time. So first I would like to go for definitions, clarify what I mean by manual and algorithmic trading. And so manual trading is pretty much when a trader acts without a strict set of rules. It may be aided by technical analysis, but technical analysis by itself is actually very subjective by nature. So it's pretty much not a strict set of rules, just using technical analysis. And then by manual trading can also be defined as discretionary trading. I actually prefer this term because it really highlights the fact that one acts with his own discretion. And then there's algorithmic trading, or it could be said automated trading or systematic trading, which actually, again, I prefer this definition is more accurate, I think. And it's when a trader, let's say usually through software, acts following a strict set of rules, and meaning that the same input, which should be probably market data, will always give the same output given those rules. And as I said, it could be a human executing these rules as long as there is no flexibility in them. And then I guess we also have to define what is success in terms of trading. The way I see this should be a profit that is reliable and also divided by the risk. So by risk I mean tolerance to drawdowns, and both in terms of depth and length. Depth is more important, but length should be also considered to some degree. And also there could be more criteria used to define success. One could be beating the market, so even if you're not profitable, as long as you do better than market, so your alpha is positive. Another one is maybe you're not beating the market, but your system somehow guards against black swan events, so very rare catastrophic events in the market. So one could forgive the system for not beating the market on average, but as long as one has kind of a more, let's say, reliable profit in that guards the very extreme negative events. So manual trading, I think it leads to very much to self-delusion. Technical analysis, as I said, is very subjective. There are some useful concepts in it that can be used to build some kind of infrastructure, I suppose, but there is also a lot of make-believe, and this is not by chance. It's because it really serves a huge educational, so to speak, industry where a lot of people sell courses on technical analysis for thousands and thousands of dollars without, of course, guaranteeing any results, which are very hard to obtain. So, and you in the technical analysis, you have all these patterns and the cap and handle, inverse cap and handle, bullish, whatever. And there is something to be said for this, but again, it's very much subjective. Many times there's an indicator that all indicators that can pretty much be applied to different time frames on the chart. So usually happens is somebody has an indicator which really believes on, and then maybe it's been using it for a 1 hour chart and then it doesn't work, and then figures out that maybe it was working on 15 minutes chart, so now I'm going to use it on a 15-minute chart, hoping that from now on I will work on this chart. These are not really objective conclusions. One should really settle for something, or at least for a system that automatically decides which one is the best chart at which that indicator can be applied. It shouldn't be done at discretionary level. And And also, yeah, there is all this pattern, bearish pattern, bullish pattern. But again, I have all these patterns. At which range should they work? Do they work for, how big should this be? Should it be in a week, or how deep and wide should it be? One could find pattern at different resolutions. Which one is really the resolution of which the pattern works, and how close does the pattern really have to be? How do you define it? That's really up in the air. It's not clearly defined anywhere, because of course it's not a science. And also, what's the value of the prediction? This is a bit more subtle, but you could say, you can make the case for which you actually notice that given a certain set of parameters, certain kind of patterns, they will tend to lead to a certain outcome. So you could feel like you have a hedge there, but actually what's really the outcome in terms of profit? Because let's say that a certain pattern, it tells you that something it will move up afterwards with a certain degree of credibility, let's say 60%, but can it actually be turned into profit? Does it move up for how long? What's kind of volatility that is implied there? There's a lot of variables that can actually impede and negate the hedge that some system gives you. So everything should be put in a wider context of what's really the cost of the value of the prediction and the cost of misprediction. And then yeah, I mean, with manual trading, when there are there's no really objective evaluation of an outcome, you can continually move the goalpost. You can say when you have success that everything works, or when you lose, you can say there's a bunch of excuses. Classical one is that, oh, I waited too long to close the position, or to act on the opening the position, or I didn't wait long enough. And then again, the short resolution should have been like 15 minutes, 3 hours, 1 hour. Next time I will try 4 hours. And then another classical one is there's market manipulation. Therefore, the system would have worked if only there wasn't market manipulation. But unfortunately, market manipulation, it's kind of part of the market. So you can really use it too much, that as an excuse. And when I say like I waited too long or not long enough, let's say again, let's see if I can make can overwrite here. Let's say that your market, it does something like this, and then your system tells you that, or indicator, whatever, tells you that you should buy here, but eventually you cannot handle the what follows right afterwards, and you give up and you close your position. But in fact, what happens is eventually the market does indeed go up. So in this case, you can say, oh, I should have waited more. But again, if you have a proper risk management and it tells you that you should close at for a certain degree of potential loss, then you can't really say that the system works. And then, of course, it needs to be based on many samples. So this is just one of the examples of how one can characterize like a loss and justify the loss, and still values a system as one that has potential, but maybe it doesn't have it. So what I would advocate for is really using simulations. And simulations are pretty much what they allow you to do is kind of relieve the past. You can actually modify the past. If you have a model of what are the actors in the simulation, then you modify those actors, then you relieve that past again, and hopefully you come to a better outcome. A simulation is essential in technology development. It's used everywhere nowadays. Architecture, engineering, geology, astronomy, fluid dynamics. If you need to build a car or on an airplane, nowadays you don't really necessarily use the wind tunnel right away. There may be some benefits to it, but first what you want to do is actually have a computer model, because it's a lot quicker. You can iterate on the 3D model and see how it behaves. And yeah, once you have a simulation, you can actually attempt to create predictive models. So a simulation doesn't necessarily imply predictive models, but it is kind of vehicle towards the ability to create a predictive models. And you can see that with weather prediction is kind of a clear example. what happens here with weather prediction. You can, once you have a physical model, basically mostly, I guess, I suppose fluid dynamics, then you can, you have a sense of what the direction of a certain winds is, and it's not necessarily, it's actually not linear. It follows some fluid dynamics, which is also affected by local temperatures. So once you build a model like that, you can kind of a step forward and have a pretty good guess of what will happen in the maybe not too far into the future, but long enough to be useful. So, but at the same time, it's very easy to create bad models. Sometimes you don't do it on purpose, I guess most of the times. Sometimes it could be something that you actually want. You want to have a positive outcome because you're trying to sell something. So typical example would be a limited data set for market. You only use one year market data, and it was bullish market, and then here you have like a predictive model that you think is great, but it's actually just based, it's really helped by very positive market. It could be also that you have a bad estimator of the outcome. Let's say that it gives you how much profit you did, but it doesn't give you really the risk. It doesn't give you how reliable that profit is, and then so maybe it's not very future proof. Or sometimes it could be oversimplification of a chaotic system. It could be like high frequency data on the market, which is could be chaotic. It's definitely very entropic. It could be also climate models, which I think they're definitely by and large they try to overshoot their ability to predict into the future. But that's kind of a different discussion. But I think it's a very interesting example. So let's say that I want to make a simulation. Let's say that I have a problem where I tend to kind of risk my life of being hit by a car, oftentimes when I go out, or sometimes when I go out. So what I want to do is first, this is of course a very abstract. I'm not going to, I don't think it's very realistic to make a model of the world, but then again, you only need to model the things that are really essential to get to an outcome. So you can have a model that is extremely simplistic, but just as simple as it needs to be, as it can be. So what you would do is build a model of the world with there's cars and there's buildings and all that, and then you build a model of yourself, how you behave in life, let's say, and then you test the model of yourself in the world, and then you decide whether you're happy with the result, and then if you're not, you build a new model. If you're happy, then you approve the model, and you kind of take this new behavior in the world. So how do we go about this? Well, first, I mean, as I said, it's very difficult to evaluate consistently good model. What you want to do is, let's say that you have a set of rules. This model is kind of pretty much software where you do, if this happens, then do this. But this set of rules, first, they should not target unique or rare cases, because they don't have a statistical value. If something only happens or happens once or twice in your life, it doesn't mean that it's going to happen again. So it could be actually, if you implement a rule around that case, it could actually give a negative effect, because there's no true cause and effect based on that unique case. And also there should be a reasoning behind it. Otherwise, if there is no reasoning, there is no predictive value. It's just you can validate in the test, but it could be just a lucky coincidence in the test. So there is an example of bad, good and bad rules. A good rule would be, a bad rule would be, don't go out on a certain specific day. Because let's say that you, on a certain day, you have an accident and you actually get run over by a car. When you go and build a model of yourself that doesn't go out on that day, then you get a complete success, because you didn't get hit by a car, but it is a unique event. That's just placed in the past. It's not going to happen again, and it's pretty much, it's useful to prove that you built successful model, but not one that I can predict. So let's say not successful really. And another pet rule would be not to go out on even days. There's really no reasoning for this. You know, it may happen to be that at that time that you got hit by a car, you had a couple of close calls, it was on even days. But if there is no reason, like let's say all cars don't go out on even days, then it should be discarded. But this is the kind of rule that one could come by, could stumble upon by kind of tuning a system, but it doesn't make sense. So here is a good rule finally. How about don't go out on Saturday night on Saturday nights? This is repeatable because it happens every week, so it's not just once. You can test it how often it happens, and then it's backed by reasoning because you know that there are more excited drivers on Saturday night. And if this works, it's not guaranteed that it will predict the future, but there is a good reasoning, and it's not just a once-off in the past, and it's better than nothing. So, and to bring it back to trading, I made an example on, I made a previous video about, I was 8 common mistakes, and one in algo trading, and one was to actually use kind of those magic patterns that you implement into your algorithm, and it gives you suddenly very good result. But why? Just because maybe once in your whole test you had like a huge 20% profit or something, and so you could easily say, oh, if I have this, I detect 4 green candle, 1 red and another green, then this rule is great because it gives me extra 20%, but it was only really a one-off, and maybe in the future it's only gonna be noise or throw you off some potential other win. So you definitely want to, if there is no reasoning, you definitely want, it's not, there should be a reasoning, or it should be at least very much repeatable. So even if it's a little bit of a black box, if it is repeatable, then you do implement it, and you hopefully you also find the reasoning behind it. So more bad rules example can be applied more on just beyond the market. Something that's very close to me is like mobile games. I used to work on those, develop original games, and usually what you often listen to is like, oh, there's this very popular, what is a Trippy Bird, Floppy Bird, very popular game. It's really low budget, it's cute, it works out, why don't you make a cute game that can make you millions? The problem is that this is really, again, it's a unique and rare event, and there's really no rationale behind it, because if one goes and see, really, if you go and see statistically, most games like this, they fail. There may be like 10,000, literally 10,000 games like this, and only one has reached a certain peak of success. So what we're doing here is we're stumbling into this survivorship bias, which is you only see who's survived, those games that survived the selection, and then you take this sample, but and you think that this is a very valid example, but in fact where 99.99% of the games, similar games, have failed, that's really not a good example. And again, it's like, you know, because it's a unique or very rare rule, and you can't make a kind of a custom out of it. So yeah, I mean, rare cases, boundary cases are special by definition, and one should try to filter them out. And same happens when you take, for example, like a very popular figure, could be Warren Buffett, could be Elon Musk, could be Bezos or whatever, and you say, oh, if I only did, you know, if I only start doing what this guy does. But you really don't know what's behind the success of a very popular person. First is popular people are very much idealized in biographies, and secondly, I mean, there's a lot of unclear variables that really may have propelled this person to success. I mean, they may have very good habits, but at the same time they may also be wrong on many things that you don't know, and they may have gotten lucky, and there's always chaos to be considered. But in everything, the chaos means basically pretty much the butterfly effect. There could be some you know, Warren Buffett could be a nobody today, or it could be moderately successful if only something didn't happen. So do not rely on just unique cases for anything. And not just not to take it personally with them, but just in general to use obvious example. So now, if I can give some hints on algo trading, I may have mentioned this before. This is a bit more subtle than what I may have mentioned before, or maybe not. So first one, rules. I talk very much about rules, if then conditional rules. Actually, what's better is to have formulas, so something that is, let's say, continuous, even if it doesn't really work, even if it works on discrete data, but it's like a continuous formula that applies to all the samples, to all the market data. That's better than a rule, because a rule is by definition, it's much easier. That is like a it's much more likely to lead to kind of a unique and or sporadic cases. Whereas if you have a discrete formula, if you have a continuous formula, then if you have a formula, then it will apply more evenly and will probably give you better, more reliable test results. But also beware of the fact that complex formula, that if you stack together a formula or you have a very complex formula, you can also kind of build a system that is like a rule, which for obvious cases, one with the Fourier transform, where you can use very simple sine waves at different amplitudes and frequencies, and you stack them together, you pretty much can make something that is very close to a step function, which is kind of a binary rule kind of approach. So beware also of not using formulas that are too complex. Having a formula or a bunch of simple formulas doesn't mean that you're necessarily on the right track. And also be mindful of the frequency at which you're working. So are you working on sub-minute data, minute data, or even if you're working with the minute data, what your function, how often does it trade, and how much does it smooth the data? So if you work at the higher frequencies or less data that is less smoothed and more frequent, you necessarily stumble into more entropy. And so you have more local events, but it's generally less future-proof, because whatever pattern you find locally, it doesn't necessarily project very much into the future. If you work at the lower frequencies, it's much more likely that you have something that will continue to work longer, but at the same time, if it is very low frequency, you just don't have enough traits to have a reliable judgment on the formulas and the models that you're applying. So you kind of have to find a way in between these, in between the extremes, and whatever works. Don't just be ideological on one or the other. And I talk about this also. It's important to, I think it's very useful to approach at kind of a recursive or stackable thinking. So it's let's say that you have a layer of logic, and then this layer logic, it's kind of a decisional logic. Ideally, you will have to have a layer on top of this logic that, because this decisional logic has some variable in it, then ideally you would also have another logic that kind of commands or decides, or ideally in a kind of a machine learning kind of approach, automatically decides what are those variables that the logic underneath should be selecting. So for example, let's say that I decide that my cost function to evaluate what's the goodness of an algorithm, I could say that 30 days it's a good length for the number of trades that have been executed to evaluate the goodness of an algorithm. But even better would be to actually have a logic on top that decides if these 30 days are better, or maybe 60 days is better. So, and this could be like a kind of a dynamic selection, or it could be a once-off selection, but it's always better to dynamicize, if I can use that word, I don't know, whatever logic you have and stack on top, and this will it should make things more robust, because there is less kind of fixed values that you're putting into the system. And so also about testing, you you have a system that gives you that, you know, you have a system that tests your models and it comes with an outcome. But ideally, you would also have a system maybe test the reliability of your testing, whether there's some obvious bugs or whether it's kind of a systemic issue with how things are evaluated. So there is no sure way of doing this, but it's good to keep in mind this kind of a mindset of always stacking on top decisional levels and build them ideally with systematic logic or machine learning, whatever. So in conclusion, I think, I mean, technology is pretty much the only rational path, viable rational path. In the worst case, at least if you implement things at the technological level with algorithms and testing and infrastructure, the worst case it will tell you that, you know, maybe you should just give up on something or on the whole predicting the market altogether. But at least you will have something that's closer to objectivity. And then yeah, it's very difficult to build predictive models. It's hard enough to make a whole testing system, and then to actually build a model on top, it's also hard. But one thing that you can do is like find a level of entropy which you really work. I think instinctively a lot of people when they get into algo trading, they think they want to do really quick trades, to have a really quick feedback. Maybe they think they don't even need to do back tests because they can put something on online, and maybe every 5 minutes will execute a trade, and it will be very easy to determine whether something works or not. But you'll quickly find out if you're operating at that level. Entropy is a lot higher, and it's in many cases a lost cause. You know, something could be done, but it's not so easy. So, and then it's kind of a personal pet peeve of mine, if I can rant about this. I think there's a lot of talk about mass scale trading with all this Robinhood or whatever brokers they're very happy to bring on board new users that are really ignorant about the market works, have no idea about making something that has some risk management or really operating with some logic behind things or not. And but the problem is that this is just a huge market. There is so many people that are selling technical analysis courses. They're selling also bots. I've seen on MetaTrader, which is a very popular platform, people from third world that they're selling trading bots for $30,000. Trading bots with I mean, the really wild, ridiculous things that really have no value, with weapons on the thumbnail, with Lamborghinis on the thumbnail. It's really ridiculous stuff. But the market is filled with this stuff, and that's why it's perpetrated. And of course, there is a demand because everybody wants to make a quick buck. And gambling, it's pretty much gambling. And people maybe they don't have a casino close by, but it's very easy to go online and pretend that they're Gordon Geek or whatever. So, and yeah, and also, brokers, exchanges, they're really happy to take your money. So don't believe that because they're available, it's that because they're trying to democratize, and that, most people, they will lose their money. So just be aware of those things. Yeah, that's pretty much my conclusion. I hope this was useful. And for any questions, comments, I'm always available. I'm happy to talk about this stuff. And until next time, have fun.